RWA.xyz. They give you some good data on private credit protocols. And another reason why we're bullish on private credit protocols in general, before we get into that, you can see that in the peak of the bull market, there was $1.5 billion in loans from private credit protocols. And you can see Maple did the bulk of it, as well as TrueFi. And that's why Maple is our largest allocation amongst these protocols. But right now we're only at 492 million. Guys, the question is, do you think that that's going to exceed all-time highs? I think yes. Interest rates are higher, so cost of capital is more expensive. And no one talks about this. These crypto companies that are coming to borrow from them, they have crypto on their balance sheets. As the bull market ensues and their balance sheet starts to balloon, it's going to make them more creditworthy. And they're going to come to protocols such as Goldfinch, such as Maple, such as Centrifuge, such as Cpool, all of which we've done videos on, and they're going to borrow. Not only that, these companies have crypto on their balance sheets as well, so it's going to increase their risk appetite and it's going to make them more likely to lend. So it's a positive self-reinforcing cycle.
Yeah, so no, I fully agree. You know, I'm super bullish, obviously, on the RWA protocols, especially, just a little bit, especially in the private credit space. Because, so there was a survey done by Bloomberg, and this was just like a week ago they did the survey actually, and it was only 387 respondents, but these are institutions, these are large investors that they surveyed. They asked them which sector in credit will perform best over the next 12 months. As you can see, there are leveraged loans, other high yield bonds, and private credit. By far, the expectation for private credit over the next 12 months, I would say 24 months, is extremely high. And I think part of that is already what you said. We kind of said this like 3 times already. Private credit in general performs well in easing environments, which means because we're higher at this moment on the Fed funds rate, you're not going to see great performance in these. You're going to see a decline in loan amounts pretty much. And we've seen that. The beginning of this year versus the beginning of last year look totally different in terms of inflows to private credit funds. And so as we move forward and the Federal Reserve, if the data keeps coming in a way that would allow the Federal Reserve to cut, then you should see on the heels of that, you'll start to see some ramping up in private credit and TradFi and in DeFi. And once we finally get to whatever the bottom is of the next interest rate cycle in terms of the Fed funds rate, that's when you're going to see the boom in terms of private credit. Because now, basically, you can look at it like this. If interest rates are high, I like to invest in private credit. Most of them come with floating rates. It doesn't make sense for me to go heavy into private credit right now. So once we are confident we've hit that bottom, then you'll start to really see the booms. But you'll see some as we start easing, because once again, they're floating, so their rates will change.
Yeah, so if we scroll down here, guys, you can see the leaders in the RWA private credit space. Centrifuge is number 1 in terms of active loans, but you can see Goldfinch is actually number 3. And in total loans, they're behind Cpool, TrueFi, Centrifuge, and Maple. So that's not bad. They have an average APY of 11%. That's the second highest. Yeah, so they have an average APY of 11.05%, just behind Credix. And then they have a cash drag of 0%. So they have 0% idle capital in all their pools, which means that once liquidity providers or backers are supplying liquidity to these pools, they're using them so sufficiently that all of it's being used. If you look at protocols like Cpool that we covered, 15% of the capital isn't being used, and this is why it represents a smaller investment in the portfolio. This would be like if you deposited $100 in a bank and you're getting 1% APY, that 1% APY only applies to $85 instead of the whole $100. When you factor in compound interest, it really fucks you. It really does. And guys, also, their market cap is $90 million, but their active loans is $107. So they're fundamentally undervalued because they have a good market cap to active loans ratio.
I just want to put this in perspective of how good this actually is when it comes to liquidity. So liquidity is always a key part of any asset investment, whatever. And so in this case, you can look at it like this. Imagine trying to walk through a waterfall, right? It's a very light waterfall. It's going to be easy to walk through. If it's fucking Niagara Falls, you're probably not going to be able to walk through. I mean, you might, but that's just going to hurt, right? So it's kind of the same concept. That's what liquidity is. Liquidity is moving. It's different from the supply of tokens or money. It's liquidity. So it's literally liquid, right? So that's how you can look at it. The fact that most of the capital, pretty much all of the capital in Goldfinch is being actively used or moved or being liquid, that increases the security of the system, increases the value of the system because you got the velocity of money working on your side. And also, it just makes it an overall safer bet because the more liquidity you have, the less risk that comes with that investment.